Okay, fun seekers, do we have an assignment for you? Today, we are going to slog our way through a typical Form 1040 tax return for a homeowner. Are we going to turn you into tax preparers in one presentation? No, but you're going to get a pretty good idea of what millions of homeowners across the country do every year, whether they do it themselves or they use one of the programs to do it or they have somebody do it for them. And what we're going to find out is it's really not as hard as people make it out to be. It's tedious. It's exacting. It's a little boring. But I use the word slog because that's exactly what we need to do. It's like walking through mud. You can do it, but it takes some work. And so what I hope you will have is the Form 1040, the first tax exercise, in front of you or on the screen somehow. If you're certainly doing this on your cell phone or a tablet, you probably should print them out because it's going to be pretty small. You'll also, yes, you don't need the tax tables. There's a link to the tax tables on the website, but you don't need to print the whole darn thing out. I mean, it's easier to just watch on the screen or have it on the screen available because you'll waste a lot of paper. You can always call up the IRS and have them send you a copy. Let's get started on the 1040 form. So we're going to be bouncing back and forth. Forgive me for sometimes going the wrong, zigging when I should zag, but we're going to be bouncing back and forth between the Form 1040 and the presentation, and then we'll take a look at the tax tables too. Slide number 12. The 1040 form is the one you really should be using if you have anything other than what qualifies for the 1040 EZ. In other words, if you have any deductions, if you have children, if you have any kind of income other than wages and unemployment compensation, then you're going to need the 1040 form. As we said in the previous presentation, the 1040A, don't bother with it. If your software program creates it, well, then they've already decided that you don't need the 1040. But the 1040A is not really that much easier than the 1040, so yeesh. And we're going to look at it in sections. We're going to look at the top half of the first page, and then the bottom half of the first page. And then we'll take a look at the top half of the second page, and then the bottom half of the second page. So I'm going to bounce now to the 1040 form here. And here it is. I've made it a little bit bigger, and I apologize for this thing. It keeps showing up. I can't find a way to get rid of it using Adobe Reader. But here it is, and what we've done is we've used the ability in Adobe Reader and other PDF programs to go in and enter it electronically, type it in. I used to write it out manually, but and then I cajole the students to do it electronically, and I thought, well, if you're not doing it electronically, why would you ask the students to do it electronically? I thought, well, I just thought it's a part of the experience, whatever. So I typed them in. So who is this? Who is this person? A King Back. A King Back. A King Back. Yeah, A King. He used to play roller derby for the Kansas City Bombers. I don't remember. Anyway, he goes over here and he puts his social security number in. Is that a good idea? Oh, yes. Don't forget to put your social security number. Don't forget to sign your return. Why? Because if you do, the IRS could, probably not in this instance, but they could claim that you filed a frivolous return. And the fines for a frivolous return used to be $500, then they went up to $1,000, and I think they're up to $1,500 now. Why do they do this? Why? Well, because people got cute, people got nasty, and they would forget conveniently forget to sign their form or put the social security number on, or in the margins they would write, IRS sucks, taxes are illegal. And the folks at the IRS are people too, sort of, kind of. And they were not happy about this. So they petitioned the Congress and said, can we fine these people for not only slowing us down in some cases, but being downright nasty to us? And the Congress said, okay. One guy turned in his tax return written on the back of a T-shirt. I think that probably was the last straw. So make sure you put in your social security number. If you have a spouse, of course, that's where the spouse's information goes. Put in your address. And this presidential election campaign, I usually just tell people don't put it in. I don't even know if they still use it anymore, because there's a little caveat going on here. If they use the money that's generated by this thing, then they limit how much they raise for themselves. So I don't know if they even still use it anymore. Now, in this next section, we put our filing status, and we discussed the filing status in the previous presentation. And for most people, you're either going to be single or married filing jointly if you're married. Again, if you're married filing separately, it usually is not a good idea. It usually means there's knives involved and court orders and the like. Here is the one that we use for a king. He is the head of household. And why is that? Because he has a son that he takes care of. And as we discussed, if there's the two parents try to take the child as the head of household, qualify them as the head of household, eventually the IRS is going to catch up with you and send you each a friendly little official letter saying, you goofed. And so, where do we put the sons, the dependents information in this next section under dependents? You click yourself and your spouse if you're married. But we need to write down the names of our dependents, specifically children. That's the most in most cases. And so, who is this? This is his son, Wayne DeBack. Wayne DeBack. Wayne DeBack. Yeah, you know Wayne. Anyway, he puts his social security number down in his relationship, and whether or not the child is under 17, because if the child is under 17, you get a great tax credit, which we'll take a look at later on. And then you sum up. I wish I could stop that happening. You sum up the boxes here. The boxes in for you, and if you're married, your spouse, any children that are living with you, and then anything else. But do you really need to put the social security number down of your child? Well, if the child is born in December of that year, you get to take them, but you're not going to be able to get a social security number that fast. You just write down will provide and get it to them later. But yeah, you do. And why is that? Well, there was a time when you didn't have to. There was a time when you did not have to write down the social security number of your dependents. And then one year they decided they were going to require people to write the social security number down of their dependents. And a funniest thing happened that one year. 8 million children just disappeared. Do you think Americans would cheat on their tax returns? Okay, so you're filled out the identifying information. Great. What's next? The next section is income. The next section is income. And for most people, folks, you're only going to have a few entries here. Most people don't have farm or rental property or business or dividends. But most people do have wages, salaries, tips, and maybe a little bit of taxable interest. And that's exactly this. Whoops, what did that happen for? Stop that. What's going on here? It did something stupid, but let's see if we can recover. Not easily. No. Wow. Love computers. Don't you just love computers? Here we are. We recovered, sort of. Most people will have wages, $51,900 in a kingback's case, and $100 of taxable interest. And everything else is empty, right? Everything else is empty. maybe you have a side business, maybe you have some IRA distributions if you're retired, pension distributions, Social Security. Well, you'll figure those out when you need to. But in the vast majority of cases, you're going to have line 7, wages, salaries, tips, and maybe a little bit of taxable income. Also, the feds do tax unemployment compensation. So if you're out of work for a while, you have to pay taxes on that if you got unemployment compensation. And then after we've totaled up, after we've enumerated, after we've listed all the income, all the income here, then we write down our total income. So is that difficult, really? I mean, is it really that difficult? I don't think so. Of course, I've been doing it now for 30 years, doing my own taxes for that long, because I just don't trust anybody else. Because people do all kinds of crazy things when they do the taxes, especially when they're doing hundreds of taxes within the 6-week window. They get all kinds of crazy and messed up. And I don't blame them. I mean, they're people too. Nobody cares about your taxes more than you do. So learn this, even if just as we'll say in the next presentation, just so that you can make sure that you know that the numbers are reasonable. All right. Now this next section here is called the adjustments. Oh my goodness, this computer is messing up. My apologies. Okay, let's see if we can write that. Yes, it's something going on with Adobe Reader. Maybe I need to upgrade to another version or downgrade to a previous version that actually worked. I don't know about you, but every time they come out with something new and improved, it screws up even more. These are called adjustments. And again, most people are not going to have that many adjustments. It's just not going to happen. In A. King Back's case, he has 2. He contributed to an IRA, so he gets to reduce his gross income by the amount, and he also paid some student loan interest, so he gets to reduce his gross income by the amount of the student loan interest. If you're a K through 12 educator, you get to up to a certain amount. I forget what it is. Deduct some of the expenses you incur on your in your work, because so many educators, K through 12 educators now, are pulling out of pocket to give the materials they need to their students because the schools don't have the money. And then health savings accounts, movings, and are you going to see most of these on your return? No. So in this case, A. King's, we have just the 2, the IRA deduction and the student loan interest. And then what we do is we total those up, and hopefully get this guy out of the way. We total those up, and then we subtract that total from the total income. So there's the total income, the total adjustments. 52,000 minus 2,000 is 50,000. And you know what some people do? They add. The IRS says that most problems, most audits and the like are created because people just do the wrong operation. Here they are reducing their gross income, and instead they added. Right, so don't do that. Read the instructions carefully. Subtract line 32 from... Part of the reason is I think they just write it so wordily and make it hard to understand. Subtract line 32 from line 20. Can't they just say line 22 minus line 36? I think that would be easier, but no, they have their own way of doing things. So that was the first page. And what we're going to do now is we're going to go back to the presentation and show... Whoa, what was that? Again, I'm wondering what's going on with my computer today. I think I need another computer. And so the first slide is simply showing us that we take the top half of page 1 and enter the wages and all the other ways of making money. And then we take the adjustments to income, student expenses, retirement contributions, and we come up with what is called the adjusted gross income, the bottom of the front page of 1040. Form 1040. And it turns out we're going to move that to the top of the next page. And this adjusted gross income is a very important number. You should really know and understand this, because many tax items are tied to the adjusted gross income, such as the ability to contribute to personal retirement accounts or use certain deductions and exemptions, medical and the like. So know that adjusted gross income. Now the next slide is trying once again to show you what we already did, to try to show you that we take our total income, all the different items up there, but for most people it's just going to be line 7, maybe a little bit on line 8, and then total that on line 22. Then take any adjustments to the income, retirement contributions, alimony paid. If you pay alimony, you get to deduct that from your taxes, student loan interest, and get the total adjustments to income, and then compute adjusted gross income equal to total income minus total adjustments. Okay, so does this make sense? I hope so. If not, stop the presentation now and take a good look at that Form 1040. Okay, I'll wait. Okay, all right. Oh, okay. So you got page 1 under your belt now? Well, because now we're ready to take a look at the top of page 2. Which is a little trickier, but not that much trickier, because what we need to take a look at now are the deductions. We have a choice. We can use the standard deduction, or we can itemize our deductions. And this is where it starts to get tricky, because you don't get to take advantage of both. It's one or the other. And the standard deduction is fairly generous. If you're single, in 2016, it's $6,300. So you get to reduce your income by $6,300 just because you're alive, whether or not you have any other deductions. If you're married, double it, $12,600, and then head of household is somewhere in between, $9,300. Or if you have itemized deductions, and itemized is just a fancy word for written out, listed, enumerated, just a list, itemized. If you have itemized deductions that are greater than the standard deduction, well, then it makes sense for you to itemize. If your itemized deductions are not greater than the standard deduction, then it doesn't make any sense for you to itemize your deductions, because you're going to pay more taxes. You would only itemize your deductions if they were greater than the standard deduction. So you get to claim the standard deduction or the itemized deductions, but you cannot claim both. And this is where it gets a little tricky, because what will happen is somebody will get a deduction for donating their car to Father Joe or some charity. And they'll get all excited because they said the car's worth $1,000, so they get to itemize their deductions. Well, no, because if you're single, you don't have a home, you don't have some of the other major deductions, the home being the big one, as we're going to see, then you get $6,300 if you're single, $12,600 if you're married right off the bat. You go to your tax person and say, hey, I got a $1,000 deduction. And he or she will say, well, do you have any other deductions? No. Well, then it doesn't really help. You just take advantage of the standard deduction. And then they get angry and go back to the charity and say, you told me. Yeah, right. Everybody gets to take advantage of personal exemptions. For every person in your family, you get to reduce your income by $4,050. And that goes up with inflation. However, if your adjusted gross income, remember that, adjusted gross income, remember that? If that gets to be too much, if it goes over a certain amount, then you start losing the ability to take advantage of the personal exemptions. So that's why we said that adjusted gross income is very important. And if you're in that situation, congratulations, because your salary is quite generous, but you need to educate yourself about what's going on here, because it can be a bit of a shocker. People say, what do you mean? What do you mean? Well, sorry, you made too much money. I didn't make too much money, did I? Well, they think you did. So let's go back to our where is it now? Let me see if I can grab it. Oh, there. Oops, wrong one. Let's try it again. That's the hang on a minute, I'll find it. Where did it go? There. Oh, and the other one disappeared on me. See, something's wrong with Adobe Acrobat that's reading the Adobe Reader. So here we are at the top of page 2. I'm going to have to stop and get the tax table because the tax table disappeared. Here we are at the top of page 2, and the first line is very easy. You just take the amount from line 37. So you just take the $50,000 for A King from the previous page, the bottom of the previous page. And here, well, on line 39, maybe you're over 65 or maybe you're blind, in which case you go ahead and click those boxes if you're in that situation. But here's line 40. Line 40 is where we either itemize our deductions or we take the standard deduction. And notice that they conveniently tell you what they are here. $6,300, as we said, for single, $12,600 for married, and then somewhere in between $9,300 for the head of household. So if A King were going to take the standard deduction, he would have just put $9,300 here. You see? Well, no, he writes $19,000. He is taking the itemized deductions. So he writes down $19,000, and the IRS says, cool. Do you have to show them? Do you have to itemize them somewhere? Do you have to list them, write them down, enumerate them? Yes. And we do that on Schedule A. So let's go here. Schedule A is hiding in the background. Here it is. And we see that Schedule A is our place where we put down our itemized deductions. We put our name and the Social Security number down, and then we go about listing, itemizing, enumerating all the different deductions. Now wait a minute. He put down 0. He put down nothing for medical expenses. Is that reasonable? I mean, he has a child. He doesn't have any medical or dental expenses. Well, he probably does, right? But notice that you write down the expenses on line 1. You then write down the adjusted gross income. Notice they don't tell you that. They just say enter the amount from 1040, line 38, which is the adjusted gross income. And then what you do is you multiply that by 10%. So if you're over 65, it's 7.5%, but for most people, 10%. You have to have at least 10% of medical expenses of your adjusted gross income before you can start to deduct this, before you can start to utilize those medical expenses. So in A Kingback, that would mean a Kingback situation. That would mean $50,000 times 10% or $5,000. He'd have to have $5,000 worth of medical expenses before he can start deducting anything above the $5,000. And that's something you don't want to take advantage of, because that means you're paying, you're somebody's in an accident or somebody's very sick. So he leaves it blank because thankfully they're both healthy and no big medical expenses. The next section are the taxes you pay. Well, not all taxes, but some are deductible. In the case of state and local taxes, you get to deduct either your income taxes or your sales taxes, but you can't take both. And in the state of California, it makes sense to do, in general, the income taxes. Maybe if you made a huge purchase for a very expensive car or something like that, you might want to take your sales taxes. In some states, they don't have income taxes, so they get to deduct their sales tax. By the way, you don't have to keep track of every single purchase you make. They depending on your income, they make an estimate of how much your sales taxes are. But you can keep track of all your sales taxes. A King turns out he owns a condominium in the South Bay, and so he pays his real estate taxes, which were reported at $2,900. And then any personal property taxes. Well, unless you have a boat or an RV, it's going to be very small. and that's the DMV tax. Now I've noticed that most programs such as TurboTax will write DMV right here, but you can't do that on these forms. You can't write here. There's no place to write. So I wrote it right here. I don't know if the IRS likes it or not, but if TurboTax does it, I'm sure they don't mind. So I wrote down DMV. But that's the DMV vehicle license fee. When you fill out your registration, you'll see on the registration a place for the vehicle license fee. It's called in California. And it'll say something like, you may be able to deduct this. You may not. If you don't have enough itemized deductions and take the standard deduction, well, you don't get to deduct it. But you may be able to. Not the whole registration. What a lot of people do is they just they put down the whole registration, and then maybe not. The IRS will come and say, "You goofed. It was just supposed to be the vehicle license fee." And so we total these three items up and put 3 items. We total these 3 items, and we put the amount here, $4,100. Now, is that more than the? No, it's not, is it? No, it's not more than the $9,300 that a king can get as a standard deduction. So what's going to put him over the edge? Oh, look at what's next. The home mortgage deduction and the interest you pay. Now, credit card interest, no. But home mortgage income interest, home mortgage insurance premiums, these are the ones that get people over the top, over that standard deduction. And some people pay interest on their investments, not too many, so we'll leave that one blank. But he is making payments on his condominium, and last year he paid $14,400 on his mortgage. And you say, what? Well, that's typical. In fact, that's low for Southern California. So he itemizes that and puts that number right here. If he had paid the points out of pocket when he bought it, well, I won't get into that. But he could deduct all the points then. If you refinance, the points. We'll discuss points when we get to Chapter 7. What's Payano talking about? Relax. But points are deductible. But when you buy the place, you can do them all in 1 year. Otherwise, you have to spread them out over the 30-year loan. Yeesh. Learn that in a tax class. So we have $14,400, and now we're over the $9,300. Any other deductions? Well, again, he has a section for gifts to charity, and he gave $500 in various forms to different charities, so he lists that down. And we're almost at the end of Schedule A, because at the bottom, casualty and theft losses, well, that's not usually something we have to deal with, but other miscellaneous deductions. Well, all these miscellaneous deductions, such as job, travel, union dues, if you have to buy clothes for your work, such as a post office letter carrier, or a nurse or doctors, you have to buy special clothes. Then you get to deduct those tax preparation fees. And so why doesn't he bother putting them down? Well, again, you total them up, you create a total, and then you go back and look at the AGI, and then multiply the adjusted gross income by 2%. And I know some of your eyes are glazing over. What's he talking about? Well, in A. King Back's case, he made $50,000 in adjusted gross income. He has to have 2% of that, which is $1,000. Do the calculation to make sure. He has to have at least $1,000 of these miscellaneous expenses before he can start deducting those. So the first $1,000 is not deductible. Anything above that would be. And so he doesn't have those, so he just basically leaves it blank. And we are at the bottom of the Schedule A. And he writes down the total $19,000. But no, wait a minute. Look, again, why don't they just use the word adjusted gross income? I don't know, but here it is, line 38. If it's over $155,650, you see, as soon as you start making a certain amount of money over, which, I don't feel too badly for you if you're making over $155,000, folks, but you have to start looking at the situation where your deduction may be limited, Right. So, but we're not going to deal with that. We're not making over 155,650. If you are, congratulations. So we take the whole 19,000 and what do we do with it? We go back to Form 1040 and there it is. Now, do you have to send in all the receipts? No. No, you don't have to send in the receipts, but make sure you have them on file because the IRS may send you a friendly little letter, official business only, U.S. government, and say, you said you gave $500 to Father Joe's village. Show us the receipt. And you're supposed to have it. You're supposed to be able to give it to them. So make sure you save your receipts. Many of them they get. The mortgage interest, the property taxes, they get that electronically from your mortgage company. So they know that. But some others, they might say, I don't know. Oh, this guy looks kind of shady. I don't know what the criteria is, how they determine that. But maybe it's just random. I think it is. I think there's some just random checks they do to see if people are complying or not. Okay, so there's the 19,000. We subtract the 50 adjusted gross income minus the 19,000, and we now have a subtotal of 31,000. Now they don't have a name for this. They just say subtract line 40 from line 38. I would put line 38 minus line 40. I don't know why. I just think it's easier to understand. But the idea is we're reducing our gross income to our adjusted gross income, and now we're reducing our adjusted gross income to our taxable income. So there's the subtotal on line 41. Now what's line 42? These are called personal exemptions. Every person in your family, because they're breathing, not pets. I know your doggy is part of the family, but the IRS doesn't consider them part of the family. Every person in your family, because they are alive, allows you to deduct from your taxes $4,050 in 2016. It goes up with inflation. So there are two individuals in a King's family, and he gets to deduct $8,100. Now notice there's that number again we saw in the Schedule A. This, I don't know where they got that magic number, but at 155,650 or more, then you may, it might not, it depends, but you may wind up losing those personal exemptions. Indeed, we'll discuss this system in detail a little bit later. So make sense? Okay, great. So $8,100 is reduced from your subtotal here. And finally, oh my gosh, we finally made it to taxable income, $22,900. So remember that number. Let's go back to the presentation. Hopefully I won't ruin something. There we are. And so the next couple of slides are just showing you what we showed you on the 1040 form. We take the adjusted gross income and we reduce it by the standard deductions or the itemized deductions. And then we get to reduce it by the personal exemptions unless we made too much money. The next slide is trying to show you the same exact thing. Adjusted gross income minus standard deductions minus personal exemptions, or adjusted gross income minus itemized deductions minus personal exemptions gives us the taxable income. And then we use the taxable income to compute our tax due. See, it says that right there. Sounds like a test question. It may be on the test, right? Taxable income is used to compute your tax due. So line 16, how do we do that? Well, there are a few different ways. But for most people, they are going to use the tax table up to $100,000. Once you're above $100,000, then you're going to use one of the tax rate schedules, but you're probably going to have a program or somebody doing it for you. I would suggest one of the programs such as TurboTax, TaxSlayer, TaxAct, and they'll do it. And what we need to become aware of now is the marginal rate versus the average tax rate, and we'll discuss those in more detail. But now what I'm going to do is I'm going to pause for a second and go get the tax table because somehow it simply disappeared. So don't go away. I'll be right back. Okay, here it is, the tax table. Now this thing drives people crazy. They look at it and see all these numbers and they just go, I can't understand it, I can't understand it, I can't understand it. And then when you explain it to them, they go, oh, that's not that hard. Right? No, it's not. It's just a table. And what you're doing is you're looking for your tax due. And in A. Kingback's case, what was it? Do you remember? You remember what it was? Let's go look. Let's go look. It was $22,900. I remember that number, okay? And now we'll go to the tax table. And we're going to go look for that number now. 1,000, 3,000, 6,000, 8,000, 15,000, 17. Here we go. 22,000. And then down to 900. So wait a minute. I see 22,900 here. I see 22,900 there. Which one do we use? Well, if you go back up here, you'll see it says at least but less than. So once we hit 22,900, you have to go to the next line, next row. And here are the different categories. Single, married filing jointly, married filing separately, or head of a... that's the one we want. So for A. King situation, we're going to use this last column. And let's see if we can make it a little bit bigger so that you can see it a little bit better. Yeah, there we go. And we come down to 22,000... Keep going. 22,900. Here's the row. Remember, we have to use the next row. You can't use the one above because that says at least but less than. As soon as it hits 22,900, come on, I just want to see this one row. Don't do that. Oh, it's highlighting both rows. My apologies. But 22,900, that's the number. Is it really that? I don't think so. But people, it just drives people crazy. They're scared of it, I guess. Go look it up on the table. This is a column because he's... head of household and 22,900. And let's see, I'm going to close this now and see if I did it right. Yes, I did. That was 2,776. And that's our tax. Wow. It took us a page and the top of the whole page, whole front page of 1040 and the top of page 2 to get to where we know how much we have to put in. We have to pay. $2,776. And how is that computed? Well, we're going to take a look at that in the presentation because it has to do with what's called your marginal tax rate. So let's go back to the presentation and take a look at those tax rates. All right, so they start at 10%, 15, 25, 28, 33, 35, and now 39.6. What's going on here? Well, here they are for 2016. The first, if you're single, $9,275 of taxable income. So this is after you've taken away the adjustments, after you've taken away the standard deduction or the itemized deduction, after you've taken away the personal exemption, if you're single. Then you get to pay 10% on the first $9,275. From $9,275 to $37,650, you're paying 15%. And then once you hit $37,650 up to $91,000, any dollars you make there are taxed at 25%. So that's why we often use 25%. So once you're making a decent salary, you're single, you know, it's likely that you're in the 25% tax bracket. And then they go up from there, all the way up to $415,000, in which case you're paying almost 40% of your income to the federal government. Same thing happens on the married side, but you notice the first two are doubled. 18,550 is twice 92,75. Why? Because there's two people, right? But then once you get up into the $400,000 range, they don't double it, right? It's a little bit higher, but not that much higher than what the single people are paying. That 39.6% rate was reintroduced in 2013 after years of fighting between the two parties. And since 2001, the rates were set up as temporary. and throughout the 2000s, there was this fight every couple of years about what's going to happen, how are you going to do it. And then finally, we had the huge clash at the end of 2012, and the rates became permanent. And then each year, they're adjusted for inflation. Huh? Well, think about it. If inflation occurs and people are paid more and have to pay more for their items and their wages go up, if the tax system is not changed, then you automatically get a tax increase with inflation. So watch what happens. Just watch one number. Watch the 9,275. Watch what happens when we go from 2016 to 2015. It went down. Huh? The tax rate stayed the same. It's still 10%, but instead of the first $9,275 being taxed at 10%, it was only the $9,225. So the brackets are adjusted upward according to inflation. And if it seems a little tricky, it's maybe not the most straightforward way to do it, but it works. As inflation goes up and you're paid more wages and you pay more from from milk and whatever, shoes, your taxes are being adjusted so that you're basically paying inflation adjusted dollars the same. You're paying the same in inflation adjusted dollars. We have a name for this kind of tax system where the more money you make, the higher your tax. It is called a progressive tax system. Now, some people don't agree with it, and we'll take a look at some alternatives in a bit. But the idea being that once you're making a certain amount of money, you've already paid for the milk, you've paid for the shoes, you've paid for the housing and the clothes and the like. And so now you can afford to pay more. And once you start making $400,000 or $500,000, you are paying a lot more than somebody who's making $50,000. And this is why some people, most notably rich Republicans, get really angry at a progressive tax system. They want everyone to pay the same. Well, this is something that society has to work out. Is it really reasonable to ask somebody who's just scraping by to pay the same rate as somebody who's not hurting at all? And that's what society has to work out. Okay? And we're going to come back to that in a moment. But first, let's take a look at an example. Here's a single person. This is not a king. This is somebody different. With $38,650 of taxable income. So we've already taken away the adjustments. We've already taken away the itemized or standard deductions. And we've already taken away the personal exemption. We're left with a taxable income of $38,650. The first $92.75 is taxed at 10%. Well, that's $927.50. Do it. Make sure you use your calculator to do it. And then between $9,275 and $37,650, we're taxed at 50%. So we take the $37,650 minus the $92.75. We're not going to get taxed on that again. They're not going to tax us on that again. And we subtract that, whatever that subtotal is, make sure I did it right. And we multiply that times 15%. And that turns out to be $4,256.25. And then this person, he or she, was bumped into the third tax bracket, but only $1,000 worth. They made $38,650, and the bracket, I chose that just for ease of calculation, $37,650, so that's $1,000. So $1,000 was taxed at 25%. So that's $250. So you add these three numbers up, and that's their total tax. Now, the tax table has all this built in, so you don't have to do these calculations. And it won't be exactly the same because the tax table goes on $50 increments. But it'll be very close, within a few bucks. If he or she had made more than $91,150, they would be in the 28% bracket. Once they hit $190,150, 33, 35, 39.6. So do you understand how the system works now? The next dollar you make is always taxed at your current marginal rate, which is why in the previous presentation we said, when we looked at current marginal rate, it's very important that you know this, because you will be making decisions based on the next dollar you make and the next dollar you're taxed on. Cool. Now, let's take a look at slide 20 and see what happens if we go to a flat tax. Because that individual that we just looked at is being taxed approximately $5,440, $30 on $38,650. And that turns out that they're paying an average tax rate of 14%. Even though they're in the 25% tax bracket, only $1,000 was taxed at that marginal tax rate. There are individuals who scream and holler and say that we should go to a flat tax. Everyone should pay the same. And that same, certain numbers that are thrown about, you hear people say 17. It's going to be more than that. It'll be about 20%, depending on how they implement it. And so, who would win? Who would lose in a flat tax? Well, if it's a pure flat tax, the lower socioeconomic classes would lose big time, and the upper socioeconomic classes would win. But the proponents say, well, you don't understand how it works. The people in the upper tax brackets, they're really not paying that 40%. They're using all these tax loopholes to make sure they don't pay a dime. And there's some truth to that. So simplification of the tax system would be most welcome. The problem with that is as soon as they start tinkering with it, you got it. Nobody can agree on anything. Everybody can agree that the darn thing's broken, but nobody can agree on how we're going to fix it. Yeah. Plus, some of the proponents will say, wait a minute, let's give the first $20,000 tax-free. All right? We'll make a standard deduction for everybody for the first 20 grand or whatever, just pick a number. So you see, they want to introduce a little bit of progressivity into the flat tax, which has some merit. Let's talk. Let's sit down, Bobby. Let's see if we can come up with something that makes sense. And then there are others who say, forget the whole darn income tax. Just get rid of it. Okay, well, who's going to pay for the government? Here's what we do. They call it the fair tax. We replace the income tax with a consumption tax. Don't tax people on how much money they make. Tax them on how much they spend. You don't want people saying, yeah, I'm going to be taxed at 40%, 50%, plus the state. Why bother making any more money? You want people to make as much money as they can, the most amount of money they can, as much money as they can. Tax them when they spend the money. Tax them. It's called a value-added tax in most countries. And I was always a big proponent for this because I love to make money and I love to save money and I don't really like to spend money. So that's good for me. The problem with that is many countries, they did not get rid of the income tax, and instead they simply put the value-added tax on top of it. Well, great. No, that wasn't our idea. No, that's not what we meant to do. No, I did. So, yes, society, the political system, the culture, our country, we're just going to have to work these things out and see what we can do to come up with something that's fairer and more efficient and not, complicated and convoluted as what we have now. But don't hold your breath. Yeah, right. Because mostly what we do is we scream at one another. Let's continue. Slide number 21, the marriage penalty. Now, if you're looking on this on your mobile device, you can't read the bottom. I'll read it for you. If the marginal rates are higher for single taxpayers, how come we sometimes hear people complain about the so-called marriage penalty? Well, that's because in a second wage earner family, the second wage earner pays their taxes at the highest marginal rate. They don't get to take advantage of the lower tax brackets. You understand? This is why they have one person who's working and the other person is staying at home, and then they say, hey, why don't we, the kids are a little older now, they go to school, why don't I go back to work and we'll have more money? Well, that's true, But you, the second wage earner, are going to be taxed at the highest marginal rate. You won't get to take advantage of the 10 and then the 15%, depending on your tax bracket. And so you find that you're paying a lot more taxes, plus because you're both working, there's more expenses just because you're both working. More takeout food and the like, more services. So they often are quite quite upset when they find that they really didn't, that getting that second job didn't really help them as much as they thought they would. The truth is, if you only have one wage earner in your family, you get taxed at a lower rate. But there's two people in the family, right? So that's why. In 2003, the Congress removed the marriage penalty, but only for the first two brackets. That's why the first two brackets are highlighted in this slide, because notice that the numbers are doubled. 9275 times 2 is 18,550. 37,650 times 2 is 75,300. But it doesn't happen after that. After that, they say, okay, you're making $150,000, $200,000. Even if you're married, you can afford it. So the marriage penalty was reduced, but only for the first two brackets. Know that. Understand that. Slide number 22. The dreaded alternative minimum tax. Well, most of us working grunts are not going to get hit with the AMT. The AMT was designed and created in the late 1960s when, as now, in the news, we heard of people who were making a gazillion dollars and not paying any taxes. So the idea was, okay, it doesn't sit well with Congress people when their constituents jump up and down and scream and holler and say, why are these millionaires, now billionaires, not paying any taxes? Well, they created the AMT to stop that. The problem was it was never adjusted for inflation. And in the late 1960s, $100,000 was a very unusual and substantial income. Now it's not. I'm not sneezing at $100,000 a year, but it's not unusual, and it's, if you have a house in Southern California and kids, it's not that substantial. So the AMT will continue to affect more and more of the middle class as wages climb with inflation, and especially two-income families. And there's always talk in Congress about eliminating it, but that would add a few $1 trillion to the deficit. So I don't know. Talk to your erected congressperson. But hey, A-King, it's only it hits you when you start making $100,000 and $120,000 and you have huge deductions such as a home mortgage interest and the like. So most people are not going to be hit with it, and A-King is not one of them. So you'll see on his Form 1040 that line is blank. Okay, so why don't we run back real quick to the Form 1040. Here it is. And sure enough, the alternative minimum tax is blank. Here's this one right here is if you got from the Affordable Care Act a subsidy, and it turns out you made too much money, you got to pay some of that back, and that's line 46. And again, most people are not going to be affected by this because most people don't have the Affordable Care Act coverage. They have their own coverage. And so we subtotal those three numbers up. In this case, most cases, these will be blank. And we re-enter this. And if you don't do that, if you don't re-enter this number here from 2776 on line 44, if you don't put it again on 47, the IRS is not going to send you a nasty letter or anything. But all the programs do it, all the accountants do it, so you should do it too. Okay? All right, so let's go back to the presentation. Where is it? Right here. And take a look at line 23. Are you still with us? I often think this is where I should make a break, but I thought, no, let's continue. We only got a few more slides to go through. And we're almost at the bottom. Most people are not going to have that many tax credits. Tax credits are very cool. Tax credits allow us to reduce our taxes dollar for dollar. And in the case of A-King Back's situation, he has two that he can take advantage of. He has some education credits on line, what is that line? Line 50. And because Wayne DeBack is less than 17 years old, he gets to take advantage of the child tax credit. So is that cool? Yes. And of course, if you had some energy credits, or if you paid taxes to a foreign country because you made money outside the United States, the United States still wants you to pay taxes on that. But wait a minute, I paid taxes first to the other country, so they say, okay, you don't have to. You'll give you a credit for that because you already paid those taxes. And then there's child care and dependent, and you take a look at these. But for the most part, most people won't have that many. And so A King has $1,100 worth of tax credits. We take the 2,776 minus the 1,100, and here it is, 1676. I'm sorry, not 1776. Being patriotic. $1,676. You with me? Okay, so let's we're gonna do it. We're gonna do it, folks. Relax. Just stick with us for a few more. If you have to take a break, take a break. Okay. So we take all our tax credits, total them up, and then reduce our taxes dollar for dollar. Do we like tax credits? Yes, we do. Because a tax credit reduces your taxes by whatever the tax credit is, dollar for dollar. Whereas a tax deduction only reduces your tax by the marginal tax rate. So what would you rather have? A tax credit for $100 or a tax deduction for $100? Well, obviously, you'd like to see a tax credit because that $100 is only going to reduce your taxes by whatever your marginal tax rate is. And I'm saying 25 and 7, even though there really isn't a 7 in California. It's 4, 6, 8. Yes, tax credits are cool. Know that. Slide 25. Wait a minute. There might be more taxes? Oh, yeah. Well, again, for the vast majority of people, this section here, let's see if we can get this a little higher here. This section right here is going to be blank. Self-employment, that's if you have your own business. Any unreported Social Security and Medicare tax, that's not going to happen unless your employer's really screwed up. Household employment taxes, if you have a nanny or somebody else in your household, you pay them, you're supposed to pay their there's part of the Social Security. Yes, because you're the employer. And there's a long story behind that. A woman who was nominated to be the first Attorney General way back in 1992-93 had a nanny and didn't pay her Social Security taxes. She didn't know. She was so confused. She didn't know, or who knows what happened. And she didn't become the country's first woman Attorney General because of that. And then here's if you don't have health insurance and you choose not to have health insurance. Whoops, I was supposed to click this box right there. Let's click that box right there. Boop. It's supposed to be there. Clicked. I have to fix that. He had full coverage for the year, so he doesn't have to pay that additional tax for that's part of the Affordable Care Act, otherwise known as Obamacare, otherwise known as Romney Care, which we'll talk about in Chapter 9. So notice, no additional taxes here. His tax bill is $1,676. Okay, so we're in the home stretch, folks. Stick with us now. Stick with us, and let's go back to the presentation. And here we are on line 63, our total taxes due. There it is, folks. There's the little snitch, the W-2 form that tells the IRS how much you made, how much was withheld, Social Security, Medicare, all the other things that were taken out of your paycheck. That's how you know. The IRS knows how much you made, so don't play games with them. Withholding. Slide 27. The IRS says that the tax system, and the courts have upheld this, is pay as you go. So you have to have withholding taken out of your paycheck. Don't try to pay your whole tax bill on April 15th. They won't be very happy. In fact, they might hit you with what's called an under withholding penalty. So you need to make sure, or do your best, to estimate your tax bill. Now, what are these two numbers? 90%, 100%. Those numbers might be important someday, maybe in an assignment. Think about it. Yeah, you want to you want it so that they owe you $100 or you owe them $100? What most people do is they over withheld. They wind up getting $2,000, $3,000, $4,000 back. Now, they come to rely on that for their vacation or to pay down their credit card bill. That's not very good financial planning, folks. No, you're giving the feds a free loan. It is better for you to reduce your withholding, use that money throughout the year to pay off the credit cards. But some people say, well, I'm not good at saving. I'll just spend it. Okay, then give it to the IRS and have them give it back to you at the end of the May or June or April. If you're self-employed, not unemployed, self-employed, then you need to do your own withholding, and you need to do it quarterly. Now, they get a little nasty. If you do this and then stop doing it because you stop making money, they'll send you a nasty letter. I've seen it. It's worded pretty nastily, saying, why didn't you send in your quarterly estimated payments? They didn't make any money. So I helped somebody send a letter saying to the IRS, I didn't make any money, so I don't need. And they, send another letter saying, okay, sorry about that. And then the next time he didn't pay his quarterly taxes, withholding, because he didn't make any money on his side business, they sent him another nasty letter saying, why didn't you do this? And so it took a couple of times before they finally realized he's not making any money anymore as a business person. So what I suggest people do is they increase the amount that's coming out of their paycheck, and then you don't have to do the quarterly, just so you have enough money in there. And that's just, it's not a big deal. It's not the end of the world, but it certainly makes life a little bit easier because you don't get those nasty letters from the IRS that give you a pause and a heart attack. In the vast majority of cases, most people are just going to be putting down how much was withheld from their paycheck, and that's line 64. Maybe they have some estimated tax payments because they were self-employed. That's what we just took a look at. And maybe they don't make enough money and they have kids. They might get the earned income credit. Now, what is this thing? It's very important, folks. In other words, the Congress is saying, look, we want you. Whoa, what happened? Here it goes again. I apologize. I don't know what's going on with Adobe here. We don't want you to stop working. We want you to keep working. But we realize, according to our statistics, that you're not doing so hot. And so we're going to essentially do a reverse tax payment. We're going to give you some money to continue to work. It makes sense. Some people don't like it. They call it welfare. But the idea is we want people to contribute, but we also want them to eat. And so we use the earned income credit. And then there are a few other places we can make payments on, some tax credits and the like. But for the vast majority of people, this is the only one they're going to have, the amount that was withheld. So we write that down right here, 2,000, and we have to ask ourselves, do we owe more than what we paid, or do we owe less than what we paid? In our case, we owed less than what we paid. We overpaid. And so we write down that amount on line 75. In this case, 2,000 minus 1676. A-King is going to get a refund of $324, and you have to tell them, IRS, please give me that money. Because if you don't, then they think, oh, he wants to roll it over to the next year. You want that applied to your next year. No, I don't. I want it. Give it to me now. I don't know why they do this, but I guess some people want to do that. I don't want to do it. And so we put in our routing number and our account number and allow them to electronically send us the money. They could also write us a check. But if we actually paid in less than what we owed, then we would put that down here on line 78 and how we're going to send them a check and pay them. Now notice, here it is, estimated tax penalties. If you don't pay enough, if you don't have 100% or 90% or 90% or 90%, 90, 100%, those numbers might be important. If you don't pay enough, they can hit you with a estimated tax penalty for under withholding. And I have had individuals who I've helped with their taxes who've been in this situation. And what you do is you write a letter. You write a letter, and I've crafted it for them, saying, "I'm sorry, I didn't withhold enough money. It won't happen again." And in all the cases that we've done it, they've never made a peep. They never came after the person. One case, my cousin did it twice. I told him after the first time, go down there and talk to your HR folks and have more money taken out of your paycheck. He never got around to doing it. So the next year, he got hit with it again. So we wrote another letter saying, "Oh, now I'm really sorry. Will you let me?" And sure enough, they didn't say anything. After that year, he finally got wise and had more money taken out. Yeah, so if you're in that situation, say, "I'm sorry." Uh-oh, what's going on here? It's disappearing. This is not good. This is not good at all. I'm going to have to pause. I'll be right back. Sorry about that. It's Adobe Reader. I do have to do something about this because this is not good. So we're done. Wow. Did you sign your return? Remember we talked about yes, if you don't sign your return, they could give you a frivolous tax penalty. If you don't sign your return, don't send in another one. Contact the IRS immediately and tell them what happened. They'll send you out a form called an affidavit, I think it is. And you sign that and say, this is in lieu of, not Lou Alcindor or Lou King, Lou, just Lou, in lieu of, instead of the actual signature on your 1040 form. Dated, and then you have to put in the occupation. A Kingback is a mattress tester, of course. Not a bad job. And then you don't have to put your phone number. They're never going to contact you by phone. They will always send you something in the mail. So make sure they have the right address. Why do they want your occupation? Well, they have these programs that they run through the occupation and they run through how much money they made, and they want to make sure it makes sense. That what you're saying is you say you're a teacher and you're making $1 million, probably selling drugs. Speaking of drugs, one of my students many years ago, very colorful individual, used to, in Northern California, grow marijuana. And he did everything on the up and up, other than the fact that marijuana is illegal. He kept track of all his expenses and the money that he made. What did he write down for his occupation? Cut flower grower. Right, a florist. Well, he didn't lie, because that's what they are. The buds are what everyone desires, and that's what he was doing. So when he got caught, he didn't have to pay, and he didn't have to. He didn't get in trouble with the IRS. He didn't get in trouble for tax evasion, which is what most drug dealers get in trouble for, the tax evasion. He had paid all his taxes. Interesting character, very interesting character. And he only spent time, just a little bit of time, in the state correctional system, not the federal. So good for him. So let's go back to the presentation because we're almost done. Slide 28. How do you avoid common filing errors? Well, the IRS says that most errors are simply arithmetic. You don't sum up the numbers correctly, or you don't add or subtract correctly, or you zig when you should have zagged, you add when you should have subtracted, and the like. So check your arithmetic, attach the necessary documentation. If you're doing it electronically, you can pay with electronic payments, or make a check. Keep copies of everything, whether electronic or paper. Check everything again. And if you need more time, don't freak out. Just file an extension, 4868. You get 6 months, and you have to pay the taxes. You have to pay what you reasonably expect to pay. If you're a little bit under, that's okay, but just make sure you paid what you think you owe, and you got another 6 months to do it. And then if there's something else going on, you can even request an extension, but the first 6 months is free, no problem. They don't come after you if you don't, for any reason. You get 6 months. And I shouldn't be telling you that because it's one of the questions on the assignment. Slide 29. What happens If you find you've made a mistake, should you A, leave the country, B, commit suicide, C, pretend it didn't happen? This is what a lot of people do. And after 3, 6, 9 months go by, they figure, okay, they didn't catch it. And then the IRS moves very slowly, folks. 13 months later, they send you a friendly little letter, official business, United States government, saying, you goofed. Yes, what do? File 1040X. You say, look, I found the error. If you find the error, obviously that's better than waiting for them to find the error. And it might be even in your favor. You might actually get money back. So the correct answer is 1040X. File 1040X and fix the mistake. Last slide. Oh, yeah. State of California. Well, once the federal 1040 is finished, then you get to tackle the State of California's Form 540. Cute, huh? It's far less than half the work. Usually there's just 2 forms. The Form 540 itself and then 540CA, which stands for California Adjustments. And this one, what it does is it takes into account the fact that some things are deductible in the state of California that are not in the feds, and some things are taxable, vice versa. For example, California does not allow you to deduct your state income taxes because you paid it to the state of California. But they also don't tax you on unemployment compensation. So that's very cool. So make sure you do the 540 after you've done the 1040. Oh, we're done. Oh, wow, that was something, wasn't it? Yeah. Go back and go over it again. My apologies, but you now know how to do the typical 1040 form for the typical homeowner. In our next presentation, we'll take a look at some tax strategies and delve deeply into that tax break we get from owning a home. Stick with us, folks. I know taxes are not the most, but they're very important, and you now know more than most everybody in the country about how to do your taxes, which is very cool. And maybe you might want to be a tax preparer. We actually have a little system here called VITA, the Volunteer Income Tax Assistance at California, and you might get involved. See ya!